All right, so I know a lot of people in our a little bit the financial clique have watched a lot of videos lately, maybe seen some commentary, but I am very lucky to have on this video with me one of, I'm going to kiss his ass a little bit here, one of my favorite commenters, RobbieGTV. Robbie G and I, we go back a little ways to when he actually did produce videos. That's the source of his subscriber base. Pop's Cabinet Shop. You got mentioned in Pop's Cabinet Shop recently.
I did.
Yeah, because
I was just trying to think. How long have we've known each other a long time, haven't we?
Yeah, since at least since '09.
Yeah, I want to say it was before that.
It might have been a little bit before that because we started
Yeah,
doing.
probably not long. I mean, I was thinking it could have been '07 or '08, but maybe not.
Mm-hmm.
Who's I've seen that name somewhere. Who's Pop's
Cabinet Shop. I'm really lucky. He's a business owner, and the guy's like a cabinet maker. Just a really cool dude. And you'll see him actually comment on the
custom cabinetry.
Yeah.
Oh, I got a soft spot for.
I want to say he's over in Texas, but him and he's good buds with D Duffy INC. I don't know if you've seen him on there.
Seen the name.
Yeah.
I don't know.
They both produce videos, but cool dude. And he made a video recently about just this week as you and I are talking the video with Josh Galt and the whole mystical silver trade of his.
The skirmish.
Yes, the wild skirmish. That was a skirmish. So, speaking of skirmishes and everything else, I think the audience will be very interested to know, and this is going to be based on the subject that we're talking about today, is what you actually do for a living, Robbie.
Oh, boy.
Yeah.
So I got to use big words now.
Do you have to use big words, you think?
Well, it's, this stuff is so, I guess, obscure, probably, to a lot of people. I have two companies that I own. One is a quantitative research / portfolio architecture think tank and consulting firm. Basically, we study institutional portfolios to determine volatility and correlation-based relationships between the strategy components inside, the larger portfolio, for the purpose of creating and licensing sort of bespoke risk modeling tools, so that the portfolio managers can sort of use these tools to help allocate risk in multiple ways depending on their client objectives. So some clients, for example, want the greatest possible absolute returns and are willing to stomach, some volatility of returns, whether monthly or otherwise, and certain, drawdown tolerance in order to accomplish those absolute returns. And others really want, minimum drawdowns, minimum standard deviation returns, with smoothing basically being the primary objective. So our tools sort of disseminate all of this detail. Typically, a large institutional portfolio will be comprised of a whole lot of strategies that are sort of opposing to each other. Some obviously make the most money in trending markets or even parabolic markets or momentum events, and others do really well when the markets move sideways or, it's long versus short, all the stuff that you would think of sort of bang into each other. And depending on the client objective, as you can imagine, there's a need for understanding really what the objective is on something that's such a behemoth. So that's our little niche, which is really, really specialized. And then the other company is is really the trading side, where we actually run a group of our own systematic programs inside larger institutional portfolios, both client managed and proprietary portfolios. So, so we're sort of rare in some cases in that we're not the sort of typical frontline asset manager dealing with individual clients. We just deal with institutions, and then they have their own clients. So.
Now, would it be an oversimplification of me to say that that's what's the popular term for it is algos? Like you build and run algorithms.
Our business is systematic or quantitative portfolio architecture for sure, but I don't know that that's the clients that we work with do everything, fundamental discretionary trading, everything. But our portion of it is definitely quantitative in nature. I mean, it's not all algo based per se. I mean, certainly the data research and everything that we do up until the point that we provide whatever we provide is based on us using algos to find out what we want to find out. But in many cases, the risk modeling is very simplistic and doesn't require the use of algorithms. But in other cases, it does. So. Okay.
That is cool. So let's see what.
It was a mouthful.
Yeah, it was. But you know what?
It was like 4 YouTube comments.
Well, I'm glad. Well, I'm glad that you were willing to get as detailed as you were about it, because the people.
Well, it really wasn't detailed. It's just in order to, how do you explain it with just 2 words? What's that? So.
Yeah. Well, I mean, for the people who are either aware of it or not aware of it, I mean, you could say the people that are unaware could consider you an investment professional, and the people that are a little bit more experienced, will understand everything you just said. So it's all good, I think.
Well, good.
Yeah. Now on to people that achieve a certain level of expertise. I mean, from working at these, working with these industrial consortiums, whatever fancy word I can put in there. But working for these people, there's no choice but to have a certain level of expertise in order to be successful in the long run.
Maybe. Yeah.
Well, what would make for somebody that, if you were to look at them and say, okay, this person is an expert in this business?
Yeah. Lamb dog.
Yes, sir.
You and your questions. What makes somebody an expert? Well, I mean, you know a little bit more about what I do than I'm probably willing to share, but I don't. I mean, if we're talking specifically about markets, I don't really believe in expertise beyond the ability to understand risk and the basic tenet of anything to do with markets, which is that no matter what anybody says, nobody knows what's going to happen next. Some people get paid a lot of money to make people believe that, and are successful at making people believe that they do know what's going to happen next. And, it's sort of the broken clock is right twice a day phenomenon.
Yeah.
See? Gold went up. I'm an expert. I'm a landscaper. Can you hear that?
A little bit. It isn't as bad as you might think it is.
I call them locusts.
Oh, that's why I've heard you refer to them as locusts before, and I thought you meant
Yeah.
like literally locusts because of it. Everybody declaring it's the end of the world all the time,
Maybe.
but
No, they just descend.
they descend and
So
they make all that
yeah, they
fucking
descend
noise.
and they make a big entrance. Yeah. So I'm sorry, I got distracted. What
No,
were
no, no,
we?
it's quite all right. What we're talking about is like expertise in trading, whether a person's a professional or non-professional. And you had mentioned, a person that seems to have a good understanding of risk modeling and something along those lines. And I would say, and because you briefly touched on the people who are paid well and well compensated to make people believe that they somehow have those understandings.
Well, but and this is where we sort of diverge from trading a little bit. But this is probably a good segue just to try to interject something, and that's that when I sort of watch what's going on in the YouTube finance community or whatever you want to call it, one of the things that I see a lot is these sort of generalized, like overgeneralized assumptions that everybody's a this or a that, or if, like for example, if you manage client assets, then it means that you make management fees and you always make money even if the clients are losing money. And it's sort of, that's just one example, but of sort of this assumed structure of everything. And the reason I bring that up in the context of this question is because you're asking about expertise. Like, so for example, in finance, there's certainly a lot of jobs where you could be an expert about something, whether, certainly certain components of what we do, we're an expert at it for a couple of different reasons. One, because we've studied it, whatever it is, but it doesn't have to have anything to do with prediction, right? Everything isn't joined at the hip just because it's connected to something else. Like it's not a throughput, So, for example, if somebody's involved in M&A, I mean, you could say they're an expert at structuring deals in a certain context, whereas maybe somebody else that wasn't experienced at doing something like that couldn't be an expert. So I'm not saying that there aren't any experts in finance about certain aspects of what they do, but I think what we're talking about here is this sort of one-to-one, the connect the dots connection between that. Somebody is an expert either at a portion of what they do, and then somehow that just immediately connects to, which means that they know what's going to happen next in silver. and that's not, you can be an expert about something like certain aspects of risk modeling or studying data, or whatever it is that you do, or even as a trader, you can be an expert at execution, or perhaps in the for example, in the HFT world, certain technical oriented people, talking about programmers in particular, might be experts at writing HFT code.
Mm-hmm.
So you just have to, I think, keep it in context. And it's probably just not a good idea to use that word in the context of. So, for example, whatever I say in the next 10 minutes, who knows? Some of it might have to do with my particular expertise, but a lot of it might have nothing to do with that. So I think that's where a lot of the riffs seem to show up, but a lot of generalizations.
Yeah, and it seems easy to observe a person who may appear to have their shit together, but whether or not that person is able to provide you with something, one, that you can make money on, or two, that you can use as some sort of a predictive measure in something you should do. I mean, I don't know, it's pretty trippy in my opinion.
Yeah, without a doubt. And I think there's other this stuff is tough but I think one major statement that I would make is, I've said this before, but the notion of somebody debating whether a particular call about a particular market is relevant or not, or whether, in other words, they're just measuring the entry event itself, and there's never any context with it. So and so was correct. Silver went up.
Yeah.
For 10 points, but not 11. 9, but not 10. So if it, right, what's the objective? People say, well, I'm long term. All right. So Wednesday. Okay. So if you get long silver now and it never goes down after the time that you got long silver, and then you're hoping to hold it for 5 years and for it to go up to a certain price, but it doesn't. So 4 years and 342 days later, you will have effectively been wrong, right? Because you didn't profit from it. I mean, so without the context of what are you risking, what are you betting, at what point do you admit that you're wrong? And these don't have to be hard decisions. I mean, just because somebody doesn't trade with a rigid stop point, just because somebody doesn't have a rigid price target, there's a lot of ways to skin the cat. I'm just saying that in general, I don't know how it's possible for people to have a discussion about something that can't be quantified. Because we're back to the broken clock, right, twice a day thing. I mean, at any given time across any given periodicity, I can show you a profitable short trade and a profitable long trade in any market at any time. So what does it mean? Unless we know exactly what we're talking about.
Yeah. Something that I've kind of noticed, and I definitely still categorize myself as a novice in this, but even at my novice level, the more that I understand the market, is it's almost, and I mean, we can just continue with the subject of silver at hand. It's a very simple and a very basic outlook on something that has a lot more factors in how that price changes than what ends up being discussed.
Sure.
And so what ends up happening is a person gives you, say, I don't know, three index model of, okay, well, I believe silver is going to go to this amount, and they lay out all these they laid out 3 different indexes that affect the price, and so I make all those little three points make sense to you, but
you're talking about intermarket correlation.
Yeah, I mean, I could give you, say, historic silver's parity to the
Indexes,
to the yen or whatever, yeah. And then point out worldwide macroeconomic problems and how precious metal prices go up due to funky news and a war on the horizon, blah blah blah, and it all makes sense. But there's like 5 more factors, and the price ends up going down anyway. And it's like, what then? That's how, when I personally, I mean, not to apply my own script to this, is when I started actually personally looking into getting into trading to make a living, and whatever information I had and whatever I traded, I needed to make money on, or that you're not exactly making a living. And I began to watch these things, and I'm like, how on earth can I take this data that's being presented to me and reliably make money from what this person's saying? Especially once the results end up being disproven.
Sure. There's a lot of moving parts. I mean, that's the summary, I think.
Yeah.
I mean, look, everybody's got different views of how they see things and how they trade, and that's what makes the market, as they say. But
sure,
you can't. Well, I don't know. Personally, our particular wheelhouse is non-prediction. There's nothing that we do that makes any assessment of whatever's happening right now, and how that's going to affect what happens in the future. We don't believe in predicting what's going to happen next. So I suppose that you could say that in the simplest form, we just trade what's there. but there's a really good reason for us having the view that we have about markets, and it's pretty simple. I mean, you have this incredibly complex thing that has a tremendous number of participants doing a tremendous number of different things across a tremendous number of periodicities for a tremendous number of different reasons, right?
Yes.
So that's the case in pretty much any liquid market. But now you have all that complexity, and then you throw in the wild card, and that's that regardless of what your particular analysis is, and you were just talking about correlation for a particular market, what pressure does this have on it? What pressure does this potentially inversely, the dollar, the yen, indexes, treasuries, yada, 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 interact. And then because of that being the situation right now, I believe that silver will go up. So first of all, let's sort of dissect, right? What's wrong with that in the sense that what we already talked about, up for how long, with what risk, right? So if you don't define that, then it's sort of really tough to quantify whether it's relevant from a risk context, or whether you've won or not, or whether you've lost, or what the situation is. But now you throw the additional monkey wrench into it that I think of markets like a deck of cards, in the same way that a blackjack player would think of a deck of cards. If your strategy is based on counting, you're going to try to gain an edge against the casino by counting cards. What's the one thing that's really important for that strategy to work? Right? It's that the cards are shuffled, they're put in the shoe, and the cut card's there, and you know how many cards have come. So you can count, and then you know at a certain point when you have an advantage, right? Because of probability, which it's not to say that trading has anything to do with blackjack, but the one important part about being a card counter is that the dealer doesn't shuffle the deck after every deal. Because if he did, then what would be the point of counting anymore, right?
Right.
So to us, when we think about fundamental discretionary trading and the analysis of a bunch of factors at any given point in time, the issue that I have with it is no matter how right you may be right now, and when I say now, I mean this second, this tick, at any point in the future, it can be completely disrupted by new information coming into markets, which is something that happens all the time. So when you have that being the case, along with a lack of quantification of what the relevance of the trade is in terms of the objective and what the risk is on the trade, it just doesn't make sense to me. I mean, the value of prediction, I mean.
Well, like here's the thing. One of my earliest lessons in trading, and it's one that people have worked very, very hard to make sure that I saw was important. It wasn't going to be a matter of the real issue when you're really serious about this business, from what I've been taught, isn't like, well, how many times can I be right? What am I going to do when I'm right? The real issue is something that's entirely under our control, and that's what are we going to do when we're wrong? I mean, we can control how much money we lose.
Right.
That's the one factor, and that's something that I see there is an absolute lack of. I mean, even the biggest stock crawl, Kenny Glick, right?
Don't know that one. But.
Oh, hitthebid.com. Hit the Bid Radio, maybe.
Okay.
I'm flailing here. Throw me a bone. Okay.
No, I have never been.
I'll send you a fucking link. You'll love him. He's awesome. Anyway, he makes stock picks. You know, he's on the Twitter and everything. You know, giving little hot picks, and he's got a fairly solid accuracy rate. But you know, nothing on risk modeling, nothing on risk management, or you know what's going to happen when this trade goes wrong. And I don't know if the people that produce such content are just ignorant of that, or if they just assume it, but they don't talk about it at all. And I find that concerning.
Yeah, I mean, I think it's. I don't know that it's that uncommon. I mean, I think when you talk to retail traders and investors, there's probably going to be a general consensus that that's the path to success in trading or in investing is being right. So it's easy to understand that would be what people seek out, is that information, because if they're not experienced or nobody's taught them really how to manage risk or why it's important or how to really sort of approach it from the level that a professional would approach it, you can't really blame people for seeking out that information, I suppose. So that's what makes the market, those types of people exist because people seek them out, right? So
yeah.
But it is an interesting point in the sense that if you surveyed a huge number of professionals, or even a small number of professionals that trade for a living and do so, I don't even want to say at a high level, really at any level, if they're managing other people's money, the focus is always on what you don't lose, not on what you make, because the what you make part kind of takes care of itself, because everything sort of fits into the context of a specific risk parameter. And that goes for everybody. I mean, whether they're fundamental discretionary guys or quantitative guys, it's pretty much the same. I mean, the simplest analogy would be, if you bet $1 a trade and your objective is $2, then when you add up all those dollars when you lose, whatever that number is might be less than palatable. So that becomes a deal breaker. I don't care if I made X because I had to withstand this, because obviously there's a natural ebb and flow in returns in any strategy that somebody employs. So that becomes sort of the number one priority, at least for people like us. It's all we think about is how do you meet the risk objectives of what you're trying to do, because the rest has to be a sacrifice. In other words, what you don't do is you don't go, I want to make $2 a trade, but I don't want to have to bet $1 to make the $2 a trade and withstand that drawdown. So here's what I'll do. I'll bet 50 cents a trade and I'll still make $2 a trade. Right? And then what happens is in the context of whatever your strategy is, it doesn't work and you blow up. Right? So there always has to be a give and a take. Risk and reward joined at the hip in all things. This is not a market thing in terms of exchange markets and people trading. Risk reward is present in anything that you invest in. It's always going to be the case, whether it's real estate or anything else. So everybody wants to buy a house for $10,000 and sell it for $1 million. Miraculously, that never happens. Right. There's a reason for it, right? Being aware of risk. I would say that if for no other reason, the reason to make it a priority is because the statistics are alarmingly against people who don't. Retail traders as a group are losers 95% of the time, roughly. And the number one reason that they lose is not because they're not right enough or that they don't have a handle on the markets that they're trading or they don't understand what they're doing. In almost all cases, it usually has to do with accepting anything as a win, because a win is a win. And then when it's not a win, holding on to it and hoping that it's going to become a win, and then eventually surrendering, and then it becomes a loss that's very large, and you get 2, 3, 4, 6, 8 of those, and sayonara, right? So where they could have avoided that if they did certain things, but they won't do it because they don't want to feel the pain of not winning. So they try to do everything they can to try to win or to try to be right. They focus all their energy on that. And, a lot of people would probably be surprised to know what the win rates are of typical institutional programs. But they rarely break 55 or 60%. In fact, I think for the majority of our intermediate to long-term trend programs that hovers in the 40 to 42% range typically is the number of times that we're quote unquote right about a trade. Of course, we're trading entirely non-predictably, but
now that statistic,
it doesn't take a genius to figure out why that is. So, Robbie G, how could you win 40% of the time and still make money every year? Well, I mean, it's there's only one way to do it, and that's make more when you win than you lose when you lose, and that tends to be the common thread running through the vast majority of the trading programs that are successful. And when I say successful, I mean over the last 20 years, they've never had a 2 to 3 year period typically without that hasn't made money. Any trading strategy, whether it's fundamental discretionary or systematic, is going to have losing periods. It's unavoidable. And if you try, I personally believe that if you try to avoid it, you're sort of inviting more pain. The quickest way to the exit is to like I said, try to win all the time, because you can't. So nobody ever does. So
we end up either one chasing a carrot or curve fitting to the point that you destroy yourself anyway, right?
Right. I mean, there's no shortcuts. It's never easy. I mean, look, at the end of the day, most strategies are going to kind of land in one. There's sort of a line, and they swing to one side or the other. Usually, the ones that have the staying power are going to sort of be in the middle of this line. But to sort of understand the extremes, on the one hand, you have these absolute return strategies that have tremendously successful years, a couple 100% in years like 2008, where you have volatility expansion, whatever. Mm-hmm. But they also have increased volatility of returns. So there's a penalty for that. If you want to make the most money when volatility expands, guess what? When volatility contracts, you're potentially going to lose the most money.
So like to put that in layman's terms, while that company may have finished that year at 100%, they may have been down like negative 30% by the second quarter, but bounced back later on because they're playing with that much movement.
And any given year might be a losing year, but you start adding up 3-year periods, and they're just killing the indexes, right? So that's, on the one hand, you have potentially strategies that have win rates as low and into the 30s or even the high 20s that are effectively sort of they're like betting $1 to make $6, $7. So when you win, you have these huge wins. When you lose, they're small, but they're going to be frequent. So depending on how things lay out, if you don't have an opportunity to catch these big moves because they're not there,
right?
Was surprise. I mean, you can't win. You can't win if whatever is relevant to your strategy winning isn't present in the market. I mean, and we go through this even with some fairly savvy clients, believe it or not. People go, I don't understand. How come the trend following models in this market had such a bad year last year? And you hold up a chart of daily or weekly pars, and you go, it's like paint by numbers. What do you see? See how it all goes like sideways? There's no fucking trend. That's why. It's a trend program that didn't have a trend to trade.
Right.
That's that it didn't make money. And the same thing with any type of strategy. So, you can only get what's there. And because whatever you're doing isn't always there, and this can come down to predictive type strategies too. I believe that when such and such is happening in the dollar and such is happening in treasuries, and this is inverse to this, but this is correlated with this, that it almost always means silver's going to go up, right? And that's fine.
Yeah, I mean that's not
a viable strategy. So there you go.
Yeah, and that's not all that different.
You get long silver.
Yeah,
good for you. But you got to understand that sometimes these relationships are going to decouple, and when they do, you got to understand, what does it mean? Does it mean that you're wrong? Does it mean that you're an idiot? Does it mean that your analysis is suspect? Or does it mean a guy with another YouTube channel is an idiot and you need to make a video telling everybody what an idiot he is? I mean, look, any strategy is is not going to be successful in some market condition. It doesn't matter what it is. So in the end, it's going to matter how well prepared you are to sort of roll through the rough spots of not being right. And that's where the risk component comes in. And that is what you and I have talked about a little bit, that I never see it. I honestly don't think that I've ever seen a video that talked about risk specifically. I mean, people talk about it, but it's a word where if somebody doesn't really, well, what does that mean? For somebody to, I mean, I'm certainly not going to do it, but I would think that somebody would go, here is an example of how you might have a trading strategy that did this, and this is how you would manage risk, and this is how, this would be the result, and kind of mock up a little thing to kind of, have some sort of educational value. But I've yet to see it. Granted, maybe it's out there. I don't know. I don't look for this stuff. I mean, what a lot of people don't realize about me is that I sort of happened into these connections with these financial channels through other people. My original, when I started coming on YouTube, it had absolutely nothing to do with finance. And what happened is I met a few people, and over many years, acquaintances became friends. There's not many of them, but there's a handful of them. And then, they watch other channels, and you hear about things, and you go to this, and the next thing you know, I'm subscribed to these few people who tend to talk about silver. But, I see that sometimes people, there's people out there that think I'm a shill or whatever they're, the evil bankster or whatever. And they go, oh no, he's coming on here to get information, and he's, whatever. I mean, it's just the, just simple little YouTube connections of one guy subscribed to this channel, and then you go over there, and so I don't know whether those videos exist. They probably do. I mean, YouTube's got everything, so there probably are videos out there from day traders that are a little bit more advanced that are talking about the context of risk management and how to put it into the context of what you're doing.
Well, I have actually looked into trying to find this information, because oh man, when was it that I was doing that $500 project? Anyway, around the time that I was trying to put together that portfolio, I came across something that said, well, your risk-reward ratio needs to be 3-to-1, or 1-to-3, however the case may be. If you're putting $1 at risk, then you need to make $3 from it. But it never really got into the nuts and bolts of how that's accomplished.
That's not true, by the way. There's no just like anything in the market. There's no generalizations. I mean, you can build a program that's very, very successful with 1-to-1, with half-to-1, with 2-to-1, to 7-to-1, to 6-to-1, and actually the most successful programs are a blend of them, obviously covering a lot of range of periodicities for any particular strategy. And an even better one is to have competing strategies like we deal with in our portfolios, where they profit from different types of market conditions, and then they have that mathematical advantage that runs through all of them. So, but the typical retail investor is capital limited. So, in order to have strategies that are that diverse, you got to have a lot of money to spread around to the piles. So there's a certain limitation, which makes it even tougher for the typical retail trader investor to make money.
Well, yeah,
which makes it even more important that they manage their risk.
Well, your retail traders are going to end up having to only be in 1 or 2 markets. Not be able to really spread it out like what a good model would want you to, right?
Well, some of our particular model groups, like the trend following group, I think has, I don't know the exact number, but over 250 individual model components that are interacting with each other. So, that's a lot of little piles of capital to spread around. And the reason I bring that up is because when you're diversifying that much, think about it like being a gambler. I always go back to the gambling stuff, because most of my programs are based on game theory, because it's something I'm really interested in, is why and how casinos always make money over the long run, and we incorporate the same types of ideas into our trading model. But anyway, now I lost my train of thought again. So when you think about that context, where if in a gambling context in a casino, what do you have? You have multiple pits, multiple bet levels, multiple games, going on at different times. why, right? Is it just to service the crowds that come in here? Well, it is, but there's another reason for it too, and that's event series, right?
Yeah.
Diversity. You have this mathematical edge that runs through everything. What's the surest way to get a smooth result from that? Have a shitload of different things going on at once that are all hedging each other, basically, for lack of a better word.
Okay.
And when you can't, the more that you can do that, the more that you can have less sophistication in your risk model and still get away with it, obviously, because you have more kind of things to pick up the slack, right? And smooth and make up for little things in the markets like gaps and slippage and all that kind of stuff. So, and again, this goes for discretionary traders too. It doesn't have to be just systematic. I mean, there's fundamental discretionary traders out there that they're trading 50, 60, 70 markets with whatever their strategies are that might be just as simple as, when the Fed meets and interest rates are this and the number goes up and the claims number is down and, blah, 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 then we buy XYZ, right? And they have, lots of markets that they do that based on a combination of intermarket correlation, news, whatever.
Yeah.
So it can be applied to any context, but now sort of solidify that down to the typical guy who you might run into on YouTube, that's got $5,000, $10,000 to his name. And he's going, I want to figure out how to buy silver and make money at it. It's a pretty tall order, is my point.
Right.
Especially if you're trying to time the market, which is the toughest thing to do, rather than just trade from some fundamental discretionary rule set. So it's tough stuff, man. It's really
well. The way that
it's really easy to lose your money.
The way that I'm seeing it in my practice and in my trading, to put a finer point on what you were talking about in smoothing it out, smoothing out those gains and spreading it around, instead of me put all that I'm trying to go for in a low position on silver and hope that it somehow gaps 25%. That ends up being a very, very unrealistic expectation. It'd be more realistic for me to move around to 10 or more different positions and expect to have maybe 2% of volatility or 1% of volatility versus per product. That's
right.
a smoother return for me.
Very important. As long as you have the the capital to put into those little piles, then you've got to allocate risk to each one of those ideas. So especially if they're potentially occurring at the same time.
Well, and the side benefit of that for me as well is, let's say one of those 10 choices that I've made is the wrong choice. Well, guess what happens? Instead of me being flat out wrong in my huge ass position on silver, I'm wrong in 1/10 of my portfolio, and its drawdown is a fraction of a fraction.
You are exactly right, sir.
Yeah.
That's my Ed McMahon. Yes.
So that's pretty cool, and you know what? It's I don't know.
That's probably another big tangent.
Well, you and I could probably sit here and be like, "Hey, Ron, how's it going?" I'm like, "Oh, dude, it was so sweet. The price action crossed the 55 EMA, and you know what? I'm long, baby."
Well, you're in that you're in the honeymoon of trading now, so you're a little overexcitable, I think.
No. I wrote, and I've got my journal here. I made a trade the other day, and according to my journal, I didn't feel one way or the other about it. So it is written, sir. I'm good.
Good. Fantastic. You traded to your rules.
Yes.
I'm proud of you.
I think it's the first time ever. I've always managed to tweak it a little.
Are you going to change your mind in the middle of the trade, or do you have your objective and your risk
What are you, fucking psychic?
Come on, you're gonna be like, oh, the Fed's meeting. What are they gonna say? Taper, no taper. Fuck. You'll be changing it.
It's getting better. It's getting better. It's getting better.
It's hard on your emotions. I will say for sure. I have this has been a long process for me, and I do have this very, have had for a very long time this deep interest in the increasing complexity of markets and wanting to study them as if they were random. I'm very aware that markets are not random, if anything, but due to the level of complexity, I thought that it would be interesting to study them as if they were, which is where the game theory stuff comes in. And so regardless of that interest, if I didn't have that interest, I would still almost surely be a systematic trader, because I think you have to know what your personality is and whether you're the type of guy who likes to make on-the-fly decisions or likes to, quantitatively and empirically study something, understand what happened in history, make sure you're not curve-fitting your ideas, make sure that it's robust, forward tested in the future, all the stuff that any quantitative developer does. And to really like that process, because your decisions are predetermined. Whether they're predictive or non-predictive decisions, the notion of predetermined decisions. If this happens, I'm going to do this. And I think it's important not to be critical of people who don't trade like that, because there are a lot of success stories of people who don't predetermine their decisions. They come in every day, they try to see what's happening, they look for where they think opportunities are. Some guys run scans to see certain things, like, they like to fade 5% moves in small caps, or, whatever. And they have this idea where they're just going to see what's happening and then make a decision not only of what to do, but how they're going to do it.
Now, to really quick, I want to translate what you just said there. In that, when you said fade, that means that a person, even though the market is saying that this thing is increasing in value, this guy goes in and says, no, you know what? I don't like the way that looks. Even though it's going up, I'm going to place my bet that it's going down, right?
Yeah, because it's moved too far, too fast.
And it's a stinker, and the product looks like a stinker.
Counter-trend type trading. The 5% is irrelevant. It could be anything. But
yeah.
That would be it. Yeah, and in our world, fading just means counter to whatever the move is. So for us, fading isn't always one direction. So to us, fading a move up or fading a move down is the same thing.
Well, and you're with you working so heavily into futures. I mean, it's much simpler to go short futures, because it's a lot.
I mean, the market action is the same, is my point.
Yeah.
So to us, it doesn't. Fading is just trading opposite of the prevailing direction. So, but that's fine. I mean, either. So yeah.
Well,
so
I just needed to define the fade.
Whatever your strategy is, you can do that, and that's fine. But the important caveat, of course, back to what this whole discussion has been about, is that the people who are successful at trading on the fly, for lack of a better term, having just let the markets tell you where the opportunities are, and even if their objectives and their risk changes, they have a framework that they work within. So in a certain volatility, they might say, well, this market's a little wider right now, so I want to give it a little bit more room, so I'm going to trade less contracts with a bigger stop rather than more contracts with a smaller stop, and I'm really not going to try to get the usual kind of target that I might out of this trade, because there's a few other things. So in other words, on-the-fly decision-making, but it will still be in the context of a very definable risk management program within a window, so that they make sure that they maintain whatever their objectives for risk-reward relationships over time. It doesn't have to be on every trade, but they're maintaining those relationships. They like to generally make 1-to-1 or better on their trades, or whatever their objective is. They're holding that. That doesn't mean that they're not making 0.8 to 1 on one trade, and 1.5 on another, and 1 on another, and 1.2 on another, and so on. But they're averaging whatever this thing is, and the same thing on the risk side. So you have to at least kind of be doing that if you're
now in this moving along a little bit, now in this world where a person has to be a licensed accountant to do a person's taxes, shit like that. How is it that a channel can get away with saying, well, you know what, I think Starbucks is going to hit this dollar amount, and here's why, and have a nice day. I mean, what's up with that shit?
Well, I think the regulatory issues are very clearly different for people who are in the business versus people who aren't.
Okay.
That would be the first distinction that I would make. I think that even if somebody isn't a professional, and when I say that, it doesn't have to be specific to what they're talking about. Somebody can hold certain finance industry related licenses that really either have nothing to do or aren't being applied to trading in their own business. So that's not as if they're a retail broker or whatever, or something that has a first line connection with clients on that basis, but they could still get into trouble because they have the license, because the agencies tend to look at things like the difference between somebody who is supposed to know better versus somebody who isn't sort of presenting themselves as somebody who's a professional. So therefore, it probably wouldn't go anywhere. Like if somebody tried to sue you
right.
for something that you said about silver, you don't have a nice little license that somebody can go, oh, look at that, he's got a Series 63, or he's got a Series 7, or he's got a Series 3, or whatever, and then contact the agency, and then they, obviously, you're known. So then somebody goes, oh, maybe there's something to get, and then I'm going to sue based on the fact that he's supposed to know better than to give me this advice, and the next thing you know, you're in trouble.
Okay.
But I'd say for most people, I think more people should run disclaimers, even if they're not professionals, just standard risk disclaimers and what the real risks are to your capital, and then that it's not a joke, and you shouldn't just be like surfing around in YouTube channels trying to see what somebody says to try to make your trading decisions. It's a really bad idea.
Well, you and I had talked about this about my my financial blog, and that what's really presented to the audience. I mean, some of the stuff we talk about really comes off like, wow, this guy, myself, when I talk about something like, wow, this guy is well researched. He's really presenting this stuff, and honestly, at this level, I'm a hobbyist on here talking, right?
Right.
As well as so many of these other guys that say, well, you know what, I think the spiders are going to be good, and we're going to, LinkedIn, and
it's probably just conversation. I really don't think that it matters. But when you're in a position to have to deal with audits and things like you have to do from the regulatory agencies from time to time, and you realize how stringent it is. I mean, especially since the financial crisis, and in the post Madoff and MF Global debacle era, more than ever.
Well, there was that suit that that group of celebrities that had, it was like a hobby fund that they had, and they sued J.P. Morgan. I think was it Goldman or J.P.?
I think it was J.P.
Okay, they sued them because of their losses, and I'm thinking, wow, every prospectus says, kiss your money goodbye, asshole. Like.
Right. Well, of course, then you have that's a whole other can of worms. Like,
well, yeah.
Off prospectus communication, and whether it's superseded, and this just becomes a battle for the attorneys. But I think when it comes to, it wouldn't matter, because if people paid attention to what was important and they were giving the right advice rather than just, in other words, there's nothing wrong with saying, I think silver's going to go up, for like an amateur guy to say that, or
I'm entertained by some of the theories that are presented.
Great. I watch the videos; it's fine.
Yeah,
and I also think it's great it's very amusing in my case to watch the skirmishes that come as a result of people disagreeing about something that isn't quantified to begin with, which is what we talked about first. But but that's neither here nor there. I think that anybody that gives any kind of specific advice should be careful. And if they hold any licenses or they're professional, and I told a certain somebody that recently, and he knows who he is, and he's probably going to listen to this.
You think he'll make it 54 minutes into this? He should.
And and you know, the information that you're giving is what's important. Now, I have a channel. I don't make videos. I do comment on a lot. You know, I have a lot of time on my hands during the day waiting for for life to unfold for me as it normally does. And I enjoy it, and I'm entertained by it, and I make a lot of comments. But nobody's ever going to find a comment from me advising what somebody should invest in, or how much they should trade, or in what direction, and how they should construct their portfolio. Pretty much, you know, I'm a broken record. I just keep saying different variants of just fuck all that and manage your risk over and over and over again. That's pretty much what I constantly say. Nobody is listening. I mean, probably, but I would feel kind of, I don't know, if I didn't, because I truly think it's important, and I don't want to see anybody get hurt, and I have absolutely no vested interest. I mean, I don't, you know, I'm not involved in retail money at all. So, you know, it's anybody who thinks, well, yeah, you're just doing whatever, and people PM you, and then you get them to give you money. We have nothing to do with retail money. I don't have, you know, any vested interest in any of the time, you know, that I spend or what I say. You know, it's all 100% from the heart. People can believe that or not. I really don't give a fuck, but it's the truth. So I think that, and I think more people that know better, and there are a few of them out there, should maybe take a page from that book, because there's a lot of people that got seriously injured watching this parabolic move in silver, and, you know, sell everything you have and max out your credit cards and buy silver and all that shit that was out there.
Well,
it's a travesty, really. I mean,
I actually have a story about that related to it, and I think this is a very good time to share the story. My parents, they're still with me, thank goodness. I'm very blessed, and they have a neighbor that they listen to a certain conservative talk show host who's very much into the whole doom thing, end of the world, and whatever. Well, this particular talk show host, because they listen to this person so much, also, and this was a few years back, advertised rolling an IRA into a silver and gold certificate program. And these people literally got obliterated. I mean, utterly, unequivocally, and just tragically obliterated financially because of this move. And it was the equivalent of taking an IRA that they had worked their lifetimes towards, and they rolled it into what was essentially a penny stock. I mean, we're not talking, they weren't getting into a Power Shares ETF here.
Yeah, pink sheets.
Yeah. And what had happened was, because they had watched that host and listened to that host, they trusted who he was advertising with, and they made that move. And these are people that have worked a lifetime.
Oh yeah, it's very common tale. Sadly, it's a common tale.
Oddly enough, they aren't stupid people either. You know.
Well, I know, but that's the thing. I mean, that's a whole other road that we don't want to go down. And
yeah,
government protectionism, and where you draw the line, and protecting people from themselves and all that. But you know, I think people would be surprised to know how stringent the industry is on specifics amongst people who are registered.